familiar when you read Wall Street journals? Do you feel out of place when you hear about stock prices, portfolio management, dividends, or risks? Do you want to get better at financial management? If the answer to all or any of these questions is yes, then we offer you corporate finance course here at ISB. That you just did your MBA from the Indian School of Business, and probably it's right to assume that 10 years down the line you'll be pretty well off financially. But think again, if you don't plan well, things can go south pretty quick. You can counter argue that you have your family, your friends, or probably you just work for a behemoth with a huge conglomerate. But then think again, if wise decisions and prudent decisions are not taken financially, then the future might not look that rosy for you. So now let's look at the different areas that we'll be covering as part of corporate finance here at ISB. So the first part deals with the types of firms. Now, obviously, you might have heard of limited liable corporations, private partnerships, private ownerships. So essentially, this part deals with giving you a little more knowledge on the different kinds of organizations that are there and the kind of financials and corporate governance that is involved with each of these. Second, we come up to time value of money, where we essentially deal with two broad topics. One is NPV and the other one is APV. NPV broadly talks about the valuation of your firm at, on the present day, discounting all the future cash flows. APV also is a way to find the valuation of your firm, but you essentially use that when you have high debt levels or you have constant debt throughout your future business years. Next, we come to capital structure. The term in itself may sound pretty fancy, but then all it entails is what does your business combination look like? How much debt do you have? How much of your own equity you have put in your business? And what is the spare amount of cash that you have for any contingency? So essentially, it tells you, it also gives you a broad idea of the kind of benefits that you get when you opt for debt financing, and it'll also tell you what should an ideal combination of capital structure should be. Um, next, the next part we come to returns and risks, in which we essentially talk about the two broad categories of risk that a future business or an enterprise of your could be exposed to. They are systematic and idiosyncratic risks. Now, idiosyncratic risk is something which is specific to your business, and if let's assume that you have a business tomorrow and I have a different business, the risk that your business would be exposed to will not be same as the risk that my business will be exposed to. Systematic risk, however, is industry-wide risk. For instance, if an earthquake occurs tomorrow, then that's something that both our industries would be exposed to, and both of our businesses would have to bear the consequences of such an unfortunate event. The last but not the least is arbitrage, where where we show why it's almost impossible to make unlimited profits without taking any risks, and that's what governs the working mechanism of some of the fundamental financial instruments that we'll be dealing with and studying.
Minds like you must have further questions like what corporate finance is and how is it useful. So going forward in this presentation, we'll dig deeper into the theoretical aspects as well as the practical applications of this subject. Under someone and start your own venture. How will this subject be useful for you? You must know that financing is an important and crucial part of investing into a business. You must know the present worth of what you're investing in and also the future empire that you're planning to build. Under someone and start your own business. You must know that financing is a crucial part of starting a business, knowing the present worth of your empire and the future worth as well.
From you guys would be that how do I value my business, or in fact how do I value any business project? We learn a unique method called discounted cash flow in corporate finance. Based on the present understanding of the business, we project the cash flows and then reduce the value to arrive at the current value. Why do we discount it? To understand that, let me ask you a simple question. If I were to give you $1, would you have it rather now or 1 year later? I'm guessing you will have it right now. This simple concept is central to studying finance and it is called time value for money. We just saw that a lot can change in 1 year. When we are projecting future cash flows, we are basing our assumptions on expected returns. This expectations is a function of several uncertainties, like in the market, in economy, in your own business. And whenever there is uncertainty, there is always a financial risk. This is another very important concept that we'll be covering in corporate finance. The riskier an asset or project, the more return an investor should get as an incentive of taking that risk. Intuitive understanding of this concept, let us assume that I am Delphina and I have a crush on Ryan Gosling. I can meet him if I take the risk of crossing the valley of fire. If I don't, I could end up with Shakti Kapoor. With so many uncertainties in a market, how can I possibly evaluate a project or a business decision? Well, don't worry. Corporate finance is taking care of it. Actually, there's a theory by Modigliani Miller which compares perfect and imperfect markets. In a perfect market, there are no taxes, no transaction costs, no information asymmetry, which means what you know as an investor, I know as a company, and there are no bankruptcy costs. With all these assumptions, we learn the financial modeling which are relevant to figure out how to value your project. And your life will be simple after studying this subject, like Modi with Miller.